In this video, we're breaking down a stock that just got hit by a major short seller, dropped sharply, and then immediately saw its CEO step in and buy $500,000 worth of shares. What you're about to learn is whether this is a rare moment where fear is creating opportunity. We are talking about a business attempting to build a full-scale digital financial ecosystem, combining lending, banking, and technology into one integrated platform designed to compound over time. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's get into it. The company is SoFi Technologies, ticker symbol SOFI. To understand why this situation is getting so much attention, you need to understand what SoFi is trying to build. SoFi is not just another fintech company offering a single product. It is trying to become a one-stop financial platform where users can borrow, save, invest, and manage their money in one place. That matters because financial services today are fragmented. Most people use multiple platforms for different needs. One for banking, one for investing, one for loans. SoFi is trying to consolidate all of that into a single ecosystem, and when that works, it creates a powerful long-term advantage. The more products a user adopts, the more valuable they become to the platform, and the harder it becomes for them to leave. That is how you build long-term customer retention and compounding revenue. Now add another layer. SoFi has a national bank charter. This is a critical piece of the story. It allows SoFi to fund its loans using customer deposits instead of relying heavily on external funding markets. That lowers its cost of capital and improves profitability over time. It also gives SoFi more control over its balance sheet and operations, so instead of just being a fintech front end, it becomes a fully integrated financial institution with technology at its core. That hybrid model is what makes SoFi interesting. But now let's talk about what just happened. SoFi stock came under pressure after short seller 𝗗𝗟𝗏𝗧 Research announced a short position in the company. This was not a mild critique. 𝗗𝗏𝗧 made several serious allegations about the company's financials and business model. They described SoFi as what they called a financial engineering treadmill, not a healthily growing origination business. That statement alone is enough to shake investor confidence. But they did not stop there. They claim that SoFi shareholders are facing ongoing dilution, suggesting that management is structuring the business in ways that allow it to hit bonus targets through loan valuations and off-balance sheet structures. According to their analysis, these structures may be disguising borrowings as revenue. This is where things start to get more technical. 𝗗𝗏𝗧 alleged that SoFi has at least $312 million of unrecorded debt. That is a very specific and serious claim. They also challenged the company's reported credit performance. According to 𝗗𝗏𝗧, SoFi's personal loan charge-off rate is closer to 6.1% compared to the 2.89% that the company reports. That is a significant gap. If true, it would suggest that credit losses are much higher than investors believe, and that directly impacts profitability and risk. Then they went even further. 𝗗𝗏𝗧 argued that SoFi's reported EBITDA of $1.054 billion is heavily inflated. They estimate that roughly $950 million of that figure could be overstated due to several factors. These include what they describe as manipulated charge-off rates, subsidized seller finance transactions, unrecorded borrowings, and an off-balance sheet lending structure that they claim allows SoFi to record borrowing proceeds as revenue. They also pointed to capitalized marketing expenses that are excluded from headline metrics. All of this paints a very aggressive picture, and it explains why the stock dropped more than 4% intraday when the news hit, before closing down about 1.3%. That is the market reacting to uncertainty. Now here is where things take a turn. After the market closed, SoFi CEO Anthony Noto stepped in and bought shares. Not a symbolic amount. He purchased 28,900 shares at an average price of $17,189 per share. That comes out to approximately $500,000 invested directly into the company's stock, and that timing is critical. This purchase happened immediately after the short seller attack. So what does that signal? When insiders buy stock, especially at moments of maximum uncertainty, it is often interpreted as a sign of confidence. Because insiders understand the business at a deeper level than outside investors, they see internal data, trends, and strategy execution. So when a CEO puts $500,000 of their own money into the stock right after a major short report, it sends a clear message. They believe the market may be wrong. Now that does not automatically mean the short seller is wrong, but it creates a direct conflict of perspectives. On one side, you have a short seller raising detailed concerns about accounting, credit quality, and business structure. On the other side, you have the CEO buying shares at the same time. And that is where the opportunity and the risk both exist. Now let's step back and analyze the business fundamentals again. because ultimately, the long-term outcome depends on execution. 𝗖𝗢𝗗𝗏 has been growing its member base consistently. More users are joining the platform and more importantly, they are adopting multiple products. That is key, because the value of the business increases significantly when users engage with multiple services. A customer who uses 𝗖𝗢𝗏 for loans, banking, and investing is far more valuable than one who uses only a single product. This is how revenue per user expands over time. Now look at the company's financial services segment. This includes checking accounts, savings, and other non-lending products. These areas are generally more stable and less cyclical than lending. So as this segment grows, it can help smooth out earnings volatility. That is an important part of the long-term strategy. But lending is still central to the business, and this is where the short seller concerns are focused. If credit quality deteriorates, or if loan performance weakens, it can have a direct impact on profitability. That is why the difference between a 2.89% charge-off rate and a 6.1% rate is so important. It is not just a small accounting detail, it changes the entire risk profile of the business, so investors need to pay close attention to this. Now let's talk about the technology side. 𝗖𝗢𝗏 is not just a lender or a bank. It also operates a technology platform that provides infrastructure services. This creates an additional revenue stream and positions the company as both a financial services provider and a technology company. That dual model is powerful if executed well, because it allows for multiple growth avenues, but it also adds complexity, and complexity can sometimes create confusion in how the business is valued. Now going back to the short seller claims, one of the more interesting points they raised was about the student loan business. They suggested that it exists largely to generate fair value gains that contribute to management bonuses. They also described the loan platform business as a wet-funded forward flow transaction, which they claim is essentially a disguised form of borrowing. According to them, the proceeds from these transactions are being recorded as fee income. These are technical claims, but they matter because they question how revenue is being recognized. And revenue recognition is one of the most important aspects of any financial company. If revenue is overstated, then earnings are overstated, and that impacts valuation. They also mentioned that management has effectively locked in $58 million through instruments that are economically similar to stock sales, while publicly stating that they have not sold shares. Again, this adds another layer to the narrative. Now here is the key question: who is right? Is this a case where a short seller has identified real issues that the market is overlooking, or is this a situation where the concerns are exaggerated and the business is stronger than it appears? That is what investors need to decide, because this is not a simple situation. There are strong arguments on both sides. On one hand, 𝗖𝗢𝗏 has a compelling long-term vision, growing user base, expanding product ecosystem, and improving profitability. On the other hand, there are serious questions being raised about financial reporting, credit quality, and business structure. And then you have the CEO stepping in with a $500,000 purchase right in the middle of it. That is what makes this such a fascinating setup, because moments like this often create significant opportunities, but only if you understand the risks. Now before we wrap up, I want to share something with you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's bring everything together. 𝗖𝗢𝗏 is facing one of the most aggressive short seller attacks we have seen recently. Muddy Waters has raised concerns about unrecorded debt of at least $312 million, potential inflation of EBITDA by as much as $950 million, and discrepancies in reported credit performance. At the same time, the CEO has responded not with words, but with action, buying 28,900 shares at an average price of $17.3189 per share, totaling about $500,000. That creates a powerful signal, not a guarantee, but a signal. And now the market is watching closely. If 𝗖𝗢𝗏 can continue to execute and address these concerns, this could turn into a major opportunity. If the concerns prove to be valid, then the risks are real, and that is what makes this moment so important. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Do you think the CEO buying shares right after a short seller attack is a strong enough signal to outweigh the concerns raised? Or do you believe the risks highlighted by Muddy Waters are too significant to ignore? Let me know your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.